Good evening, friends, and warm welcome to motilal Oswal Tower. It's always a pleasure to stand here and talk to all the investors, I would suppose, and all our esteemed clients, prospects, and friends. So it's always a very special day for me, and it's like passing an exam. So I have passed CA exams, and also whenever you pass exam after failing 3 times, so it's that kind of feel. So there must be a lot of chartered accountants when they find their roll number in the result book. What kind of happiness you get is the kind of happiness I get when I complete the wealth creation study and say it's over. So today it's kind of a celebration day for me, and thanks for joining the celebration. So let's look at what is there in store for us today. So there are basically three parts of the study. One is the conventional number crunching for last 5 years, what has happened in the market. And because even when I look at the numbers, I find it very difficult to absorb that in 5 years, in last 5 years, so much has happened. And these are the winners, and the size of the win is just staggering. And interesting thing is that this 5 years start from a very depressed post-Lehman crisis. That's the base. So you'll find some interesting numbers which might, in the current market conditions, you might find it very strange. And then we have the theme 100x and market outlook. So briefly, the concept of wealth creation is process by which an entrepreneur creates wealth out of the money which has been entrusted to the company. And this is the most mystical and magical kind of process. And stock market is about entrepreneurship. And it is the future of entrepreneurship. So how exactly the entrepreneurs out of nothing, in fact, the best entrepreneurship is when money is made out of nothing. But still, I think it is not everybody's prerogative. Most of them, they start without any money. But when you list, there is always some amount of money, capital entrusted to the entrepreneurs. So how the entrepreneur has been able to enhance the value of what you are given, more particularly visible in the stock market. Then the net wealth created in last 5 years is the net wealth between 2014 March and 2009 April 1st. What is the gap between these two adjusted for the money raised? So that's how the largest 100 has been picked up. But the companies which have not been able to beat the market has done about 18%. The companies which have not been able to beat 18%, they have been left out as a wealth creator. Earlier we used to include them also, but we found that if you have done 2% on 2 lakhs and you to come in here, that's a wrong definition of wealth creation. So this time, since the markets have moved 18%, a lot of big companies have been left out as a wealth creator. Maybe with a very small margin, but like Reliance, Hero MotoCorp, Concor, and list is long, but very large companies who are conventionally into the wealth creators, they have not made to the list. So this is a very stringent and top quality wealth creators of 100 companies. We have 3 categories, largest, fastest, and most consistent. So the largest, this goes to TCS, of course, which is the largest market cap, number 1, and 3,63,000 crores at the rate of 51% compounded. In less than 2 years, the company has been doubled in last 5 years. This, 40%, if you do 40% compounded in 2 years, you double the stock. But at 51%, I think it must have required about 1 year, 7-8 months to double the stock. ITC, strange fellow out there, but it is always there, consistent, and most likely it will be there number 2, number 3, number 4 position in years to come. And sometimes it might even hit the number 1 position. HDFC Bank, Infosys is way below 4th number. Hopefully this is because nothing is threatening right now TCS position as a number 1. I can't see what can threaten in next 2-3 years as a number 1 position. During this period, the total wealth created by 100 companies is about 29 lakhs. Of that, almost 24% has been created by IT. So IT has played a major role in terms of wealth creation during this particular period. The fastest, I think everybody's dream is to have these companies in the portfolio. The best is Eicher Motors. Almost every year it has doubled in last 5 years, 94% compounded. Bajaj Finance, I mean, this one was visible to me at a very small price, and I couldn't believe that it has moved so much. Supreme, Amar Raja Battery, Page, they're all very good. This is the time, this time in the study, all the big and fastest, all the companies are very good companies. There is no company which is iffy in terms of making it to the fastest list. Then you have the most consistent. I mean, this is almost 15 years wealth creation. In 10 out of 10 studies, the one which have appeared, and within them also the fastest. So Kotak Mahindra Bank is 34% compounded for last 10 years, and I think they have still a lot of steam left in terms of what they can do. It's a very large opportunity space, banking, and now recently they've got merger and all. So I think this momentum might continue at this thing. So Asian Paints, Sun Pharma, Hindustan Zinc. There is just one commodity company, that is Hindustan Zinc, and 8 out of 10 companies are consumer facing. So these are very, very sustainable type of wealth creation, and just because it has created wealth for last 10, 12 years, I don't think the story is over here. So there's a lot of force still left. To make it to this study, you have to have still firepower left to create wealth. Sensex have grown at about 18% compounded for last 5 years. In 2009, it was now 9,700, just about recovering from the collapse. I mean, collapse was at about, I think, 8,000 something, and now at the bottom it was, in March 9, it was 9,700. The earnings of Sensex have grown about 10%, whereas this 100 companies have grown at about 24%. And the P multiple, you see, the markets were at about 12 P at that point of time, and all this fantastic set of companies, they were also trading at about 12, 13 times. But just see the earnings growth differential of 24 and 10 has led to very different amount of return. The WealthX company have given 34% compounded, all these 100 companies, whereas the index has moved only at about 18%. So huge gap. The businesses which have done well, the largest 24% of all the wealth created in last, I mean, we have created about 29 lakh crores in last 5 years. This is almost 30% of total market cap. Right now, as we stand, market cap is about 100 lakh crores, and about 29 lakh crores has been created in this study. And these 100 companies, out of that, 24% is coming from technology. Consumer is about 20%. Financials are 90%. Auto is about 11%. I think the one striking thing is that oil and gas. I mean, this is just about 1%. In 2009, it was 22%. So you see, I think this one is going to make a huge comeback. And we are seeing already the changes. Oil prices have crashed. A lot of reforms have taken place. Diesel, petrol have been deregulated. So I think this 1% is, I'm quite sure it will make it big. I mean, earlier, ONGC and Reliance, they were there for 10 to 12 years as the largest wealth creators. I mean, this is probably, I think, largest segment of the listed space. I mean, just the HPPP IOC itself is about 10 lakh crores of sales with almost zero profit right now. So I think this entire segment is going to come back. So watch out there in oil and gas segment, what you want to pick and where exactly you want to make money. But this is going to be exciting. This is, I think, the best slide of the study. Till about 2004, 50% of all the wealth created used to be the PSU companies. This study, only 2%, 5 companies. I mean, and that too, because of base effect or something, they came into the picture. Otherwise, PSU as a class is finished off in last 5-7 years of UPA government. So I think this has been the biggest loss to the nation, and this will become the biggest opportunity also. I mean, it looks, I'm also on the hating side of the PSUs, but I think I've not seen anything like this, that from 50% coming to zero, it's like a oil company thing that 1% contribution instead of 22. But from 50% to come to 0 or 2%, I think it has to reverse. And if governance is going to be good, if the autonomy is given to the PSUs and they transform themselves into a better managed companies, I think this one will be a most contrarian, most hated, most unpopular call to get into this. So I think this space is again, watch out. This is the valuation. So here we have the companies, about 45 companies were below P of 10. I mean, this is unheard of, that 45 companies would be below 10 P in 2009. And the fear was so much that nobody, I think TCS itself was available at 10 P multiple in 2009. And it has delivered 51% compounded. So below 10 P multiple companies have clearly given 42%. But after that, actually market is quite distributed in the sense that whether you bought at 25 P or whether you bought at 12 P or 18 P, I think the distribution is pretty even. Even in price to book, I think in price to book there is no theme at all. You bought it very cheap price to book, typically you get slightly low return companies below price to book 1, but they have also not delivered anything very distinctly different. In fact, the expensive company between 3 to 4 book has been the best at about 44%. So clearly, buying cheap has not worked particularly well in last, something you bought below 10 P, 7, 8 P multiple, that has definitely worked, but otherwise, broadly it has not worked. But this one, which is a growth adjusted price to the payback period, what we do is, this is very, this ratio is found only here, and I use it personally big time, and it works brilliantly. This is growth adjusted P multiple, in the sense that you buy, today's market cap, if it is recovered in next 5 years, we call it payback ratio 1, and if it is 10 years, then we call it 2. So if you buy anything which can recover the current market cap in less than 5 years or less than 1, if you find that kind of stock, it's a multi-bagger to start with. So 45% return for 46 companies. I'm staggered to see that 46 companies out of 100 were available at less than 5 years payback period. Market was completely out of, it was very, very cheap at that point of time. And clearly, if you buy at 1, it is 45, and then 30 and 27. So the issue is that if you buy expensive, you don't have much chance to make this kind of a mega returns. This is the companies which destroyed wealth. The total destruction is about 207 lakh crores. Sorry, total wealth destroyed is about 4,18,000 crores, and 5 out of 10 of them are public sector undertakings. So again, few telecom companies and commodity companies, but basically 5 out of 10 are PSU. So PSU have been butchered all over. So this is some of the thoughts on what we saw in number crunching of last 5 years. But you can have much deeper understanding of the numbers when you go through the actual report. So 100x, the power of growth in wealth creation. Actually, when I started the study, the thought process of the study was that we do QGLP, and in that, quality, growth, longevity at reasonable price. So in that process, quality was understood. We have done a lot of quality stuff. How to measure growth, how to do blue chip investing, and all sorts of things. But we have not given enough of thought process in terms of understanding growth. And growth is the biggest multiplier in wealth creation. And so we have to, I'll talk a lot about it. So I want to do a project whereby let's understand a little more deeply about growth. And literature available on growth is very little, very scanty and very little. How to estimate growth, how to measure growth, how do you approach the entire subject, what is the importance of growth, and how growth happens. Is it a hyper growth to start with? Is it there are phases of growth. So, and what is the difference between growth and quality? So all those things will come up in this thing. But what happened was, while we were doing this, for 15 days we were struggling, then we found a book called 100:1 in US. It's a classic book, you don't get in the print anywhere, but we got some Xerox copy of 100:1. And this book showed how to do how growth investing happened in US between 50s, 60s and 70s, and what are the characteristics of the companies which they found as 100 baggers. So they found about 350 companies in 40 years. In US, about 300, 400 companies were found in 40 years. I don't know how did they, without computers, how did they do the number, but anyway, they did that, and they talked about, it's a very storied book, I would say, and we picked up a lot of stuff from there. So what we saw in Indian context, because we had 20 years data, so we said, let's understand growth through the eyes of 100x. And so we said, let's study all the super growers of this country in last 20 years. And that's where we converted the growth project into a 100x project. And here are some of the findings. So the most important piece I found, when you go to, what is 100x? What is 100x? When a stock multiplies by 100 times, that's called 100x, 1 to 100. So what you need, to make this size of money, and we are not talking about in 100 years to make 100 times. We are talking about 10, 15, 17, less than definitely 20 years. In less than 20 years, how do you make your money 1 to 100? And so it's a very difficult thing, but what it requires, the first thing it requires is the vision to see the target. Whenever you come across the company, the vision which is required, because your in equity market is all about future. So can you see the future? And can you value it today? So at times you become insightful about it. So how do you make it a framework-based seeing the future? So first you require is vision to see them, courage to buy them. When you see them, can you buy them? Do you have courage to buy? Because there is most likely nobody will help you saving it, because you will be alone when you buy it. That's my experience. So you are alone. So you have to go and buy it. If you call up anybody, they will say, it is not good. You don't know anything about it. So all the bad things they will tell you. Nobody will tell you that you go and buy it. So you are alone. So courage to see, courage to buy. I think these two are still doable. But really most difficult at this point of time is the patience to hold. Nobody holds it. I'm also as big a culprit as anybody. But the real problem is visioning is possible. Courage to buy is possible. Courage to buy enough is difficulty. But holding them is almost impossible. Now holding period has come down from a few years to few days, I think few months now. So I think this is a time to buy today and sell tomorrow, and they are the long-term investors themselves. So I think the real challenge is to find people who want to hold it for a long time. So 100x is stock prices rising 100-fold over time. The exact number is 100. 100 is not important. It's a concept. You have to think that you can make multiple times of it. Nobody can ever think would ever know how many times money can multiply. I know people who have done 1,000 times out of their investments. Like mother of all the growth stock in India so far has been Infosys. From day one, it was a prominent company, leader company, and growth company. And people came in for 2 years, people came in for 15 months, people came for 15 days. Everybody made money. And there are guys who started from day one, and they're still shareholders. So I think this is 4,000 times in 20 years. So these are the kind of super stocks you have. Then you have, so we'll get to the list, and we'll talk about them. Now, what do you mean by 100x? Because 100x doesn't happen at simple rate of interest. If you do simple rate of interest, like it will take forever to make it. It is because of the power of compounding. And I think when you're coming to stock market, I think this is the world of power of compounding. There is nothing happening in simple interest rate. So the compounded return, if you want to do 100x, in 5 years if you do it, it is 151%. If you do it in 10 years, it is about 58-60%. If you do it in 20 years, it's about 24.5%, 26% kind of thing. So, but incidentally, as Motilal ji said, the index started at 100 in 1979, and it made 10,000 in 2006. It took 26 years for the index itself to do 100 times. At current price of 28,000, index was 280 in 1983. So it has taken about 30 years for it to become 100 times. So this is the market where if 30 times can be done by the index, it's a dumb thing. You don't have to apply, you don't need any manager. You don't need smart guys. And if you do 4-5% outperformance, I think the possibility of doing 100x is very, very high. It's not a 0.01% kind of probability. Yes, it is difficult. You don't come across these ideas every day, but I think this is a land of multi-baggers, actually. Land of multi-baggers. We'll see the statistics. So why it is required? What is the importance of, why do you need a 100x or multi-baggers? You need it because investing is described as a process to laying out today's money to get more in the future. But actually, Buffett has made it a little more stringent 3 years back, defining investing as the transfer of purchasing power now with the recent expectation of receiving more purchasing power in the future. So the adjustment is the inflation. So he wants inflation and tax-adjusted return, which has to be significantly higher than today. Otherwise, why should you be bothered about coming to any of the, whether it is a fixed income, whether you come to stock market, why should you go there if you don't get purchasing power? So here is the, the mathematics of it. If you see the first two, you start with one as debt and equity as one as debt. After 20 years, if it grows at 25%, equity becomes 100 times and debt becomes 4 times only. Only 4 times at 7% post-tax compounded. I think that's the rate you get right now. 7, maybe even lower. So it goes 4 times and equity goes 100 times. Inflation adjusted of 7%, which is the inflation so far. Debt remains 1 and equity goes 26 times. So you get 26. So if you surrender a Maruti car, say 5 lakhs rupees today, you should be able to buy 26 Maruti cars after 20 years. That's the power of equity. That's the kind of, if you surrender 1 flat, you should be able to buy 26 flats after 20 years. That's the, I'm trying to make it feel a little better so that you can put more and more money into the equities. So this is how markets have moved in 30 years. This is a real, I think because some human behavior, people remember 2000 crash and more recent crash. I think the only memory, the people who are sitting outside the market, the only thing they remember is that in 2007, market crashed from 21,000 to 7,000. There is no other memory. Nobody remembers that it has become 100 times in 30 years. I have not heard from anybody. Or it has gone 7 times from 2003 to 2007. But everybody remembers 2007 to 2008 crash. I don't know. And that guides them that, okay, let's buy only fixed income, 90% fixed income. 95% fixed income. I think, I don't know what is the fixed income percentage in this entire crowd. It must be upwards of 50%. So you have two kinds of 100 baggers. First, transitories. Now, transitories are ones which are fat driven. They come and they are there for 2 years, 3 years, like companies like Satyam Computers, SSI. I think I have a brilliant practitioner who always identifies this one, and he's got a, and he has the guts to get out also at time. He calls it Hajariyas. So Satyam Computers, SSI, Unitech, I think Madhu and Bhatta both are masters of finding them and really making money out of them. And not that they don't pick up enduring ones. So we have picked the panel very, very carefully. And the enduring one, I think the real one is the enduring. Meaningful size and scale of operations, saw stock prices rise 100x or more, and almost most importantly, maintained their X status after the event. Like after 30 years, you can peacefully go and sell it and enjoy. So that's what you want. After 100x, like Infosys, they started with 50 crores. The issuance was at 31.5 crores, got listed at 50 crores, and today it is 2 lakh crores. 15,000 crores is the total dividend. 25,000 crores waiting to be distributed, 12,000 crores annual profit, 4,000 times plus dividends. I don't know, this is crazy. And it has happened right in front of us. This is not a once upon a time story. This all happened right in front of us. I refused to go for IPO meet. For 2 years, I refused to take the presentation. I don't know what is software. In 94, I didn't know what is the difference between hardware and software. So, that was the kind of ignorance we had. And here is the biggest industry out here. 24% of all the wealth created is coming from tech. So you need to be a little visionary. And our friend Bhatta was visionary to buy it at throwaway prices and still holding. And so you need that vision. I didn't have vision till about 97 to see the power of software. So this is the list of the super growers, 47 of them. As I said, Infosys 2,900 times because the cutoff date we have taken is 1st March 94. By that time, it was already 7-8 baggers. So from there, then Lupin, I think this is a very surprise number that Lupin has made it to 1,200 times. And now it must be, if you count the last 6 months appreciation, maybe it is 2,000 times. So Wipro, Motherson Sumi, I think every single name should be uttered. I mean, these are huge things. Sri Cement, Kotak Mahindra Bank, Imami, Wakarangi, Eicher Motors, 452 times. I mean, this is till March. Maybe it is 1,000 times now. So, you know, this is stunning. Asian Paint is the poorest of all at 106 times. So, now phases of growth. You know, what happens is that it's not that it has taken 12 years, average it has taken 12 years, though it is a 20-year study. But 12 years don't happen at an even pace. It is not a 45 angle line. The first year is about 4.5 times. 5x. It happens 1 to 5 in the first year itself. Second year is, 3 years is about 9x. Then 5 years is about 24x. So the rate of increase cumulatively keeps going down. But getting that first 1 or 2 years is very important, this hyper growth phase. But it is not necessary that all the stocks will have hyper growth to start with. It can have a very, very slow growth in the beginning, and then it can pick up at the middle or at the end, like Sun Pharma. I mean, it was going at one pace, but now it has become violent in the sense that as the size is rising, the growth is rising even further, which is very strange. You know, it's getting a scale on a scale. So you can have very different types of, but getting the hyper growth in your pocket is very important, whether it is before you buy or after you buy sometimes. So when you we'll get into the characteristics of these companies, but it is very important to hold on. You know, that 12, 15 years, 20 years, that journey has to be completed.